Happy Monday, boys and girls. It's been a crazy week around here. We are going through hopefully the final couple rounds. Final couple rounds of our capital raise for a boutique hotel that we are doing in Nashville. So it has definitely been all hands on deck. In fact, it's so crazy that Andy is having to wear napkins around his ears to keep everything in line. I've got to show you guys this for everybody that's watching. I mean, look at that. Look at those napkins.
It's to stop my ears from bleeding. I've been working through the nights.
Yeah, Andy. It's your last week in Puerto Rico, is it not?
I'm leaving tomorrow. Unfortunately, I have to go back and see Tyler in person. It's
Wow.
just the worst day of my life, actually.
This is the worst ever. Yeah, sorry that you don't get to work from the beach anymore. That sounds so terrible.
It is. It actually is terrible. Excuse me.
It is. Oh, that's funny. Well, anyways, so we are constantly raising capital for our investment opportunities. We typically do 506B friends and family raises. So if you are interested in investing in commercial real estate investments passively, feel free to reach out. There's a link in the description below to reach out to us, office at investwithhamilton.com. Reach out, set up a call with me, quick 15-minute call, just to kind of dive into your background, your investment criteria, what you're looking to do, and we'll talk a little bit about what I've got going on and get you on our roster so that next time we have a project coming out, you are welcome to join us in it. Anyways, let's go ahead and dive on into the Nashville market. So let's see here. 655-acre master development pitched for Gallatin. This is a absolutely massive deal coming at us from the Business Journal. Let's see here. For his Nashville debut, one Florida executive is planning one of the largest development master plans in the city's periphery. Andy, do you know off the top of your head how big Berry Farms is?
600 acres.
They probably talk about that in this article then.
Later
So
on,
Berry,
yes.
do what?
Yeah,
Wow,
later
look at
in the
you.
article.
Look at you. I'm getting a little bit of feedback, Andy. I don't know if that's your mic or if that's coming from my headphones, but it's good now. Cool. Okay, Jim Harvey, president of Tampa-based Coulterland, is eyeing the 655 acres for Nexus, a multi-phase mixed-use project in Gallatin. For those of you that are not familiar with Gallatin, it is just northeast of downtown, probably about 30 minutes, 40 minutes outside of town. Let's see here. Plans to close on the first slice of land, which is 177 acres, located at the intersection of Highway 109 and Red River Road in September. Looks like total infrastructure cost for the project will be around $108 million. That's a pretty big deal. Let's see. Its surface area is more than double that of Century Farms, the 310-acre master development in Antioch, and one of its closest peers would be the 600-acre Berry Farms in Franklin. So Berry Farms is a beautiful master plan development. Obviously, it is one of the largest in the area, which is why I thought of it when this came up. So it was cool to see that they mentioned that in here, of course. Let's see. Master plans will take around 10 years to finish and will include 1.1 million square feet of mixed-use development featuring office space, retail, and 900 apartment units across 124 acres, 109 acres of business park use, 1,350 residences, including up to 260 townhomes and 140 attached villas, and amenity space. They want to break ground on the first phase, which would be the residences this fall. There's no construction loan in the public record yet, so that doesn't necessarily mean anything. They could be looking to finalize that. And it looks like they have not selected a general contractor either. That is a massive project for Gallatin. Pretty exciting to see what is going on out there. Gallatin has had some pretty exciting news recently as well. I believe Facebook is opening up some offices up there. So it's growing rapidly. Moving on, this next one, Element Music Row apartments sell to Camden Property Trust for record price. This is a great project. Basically exactly where you would want to be if you're going to build apartments in Nashville. This is where pretty much everybody used to park when going down to Midtown. That's where that lot was. Let's see. This is also from the Business Journals, by the way. Just weeks after its Nashville debut, a Texas real estate trust has outpaced the market's biggest apartment investors. Houston's Camden Property Trust paid $157.94 million for the Element Music Row, on Demumbrian Street. The price, which equals $367,000 per unit, is a record. That is a massive record. That's a huge record. I mean, look, that just shows you the demand for multifamily in Nashville. You wouldn't be paying a price record per door if you didn't believe that the rents are going to support that. It's in a phenomenal location. You're right off the roundabout at Music Row. You're near all of the most popular bars in Midtown, and you're just off of the interstate. So the access is pretty phenomenal here, and it is a beautiful apartment complex. It does have some pretty good views too. We've been looking in the Nashville market for years to add to our existing portfolio, said Kim Callahan, who directs the firm's investor relations. Let's see, it's their second apartment purchase in Greater Nashville. Earlier this month, they spent $89 million on 328 units in Franklin. Andy, we need to call them. Clearly, they are very active and looking to buy in Nashville. I bet we could find something to sell them. Let's see, Element Music Row buy, however, surpassed what had been the largest price ever paid for a Nashville apartment complex, which was the Broadstone Gulch, selling for $339,000 per unit in December of 2019. So, I mean, all in all, I mean, $27,000, give or take, more per door. Not a huge, I mean, look, that doesn't sound like a lot, but that's what, an 8% increase over the record? I mean, that's a lot, especially when you're talking about, percentage points of returns to investors. That's pretty significant. That's really cool to see. Let's see. The complex's seller and developer was Childress Klein, which has offices in Charlotte and Atlanta. They paid $6.25 million for the vacant land in 2014. Can you imagine getting that land for $6.25 million today? It wouldn't even, back in 2014, that was a crazy price. Now you're looking at that going, damn, they got a steal for that. As of January, the 19-story property was appraised at $163.53 million. That's just outstanding. So good news for the apartment market in Nashville. It is still very, very strong. All right, let's see. This one's from the Nashville Post. Major development eyed for the East Side site. Love this because it is immediately next door to 4.5 acres that I own and have bought. So that is this is going to be. I've actually met with these buyers last month or 2 months ago to kind of look at their plans and see how we can work together on our projects. Really excited for what this group has going on. Let's see here real quick. We've got a question from On Point 7. What other markets do you focus on? So On Point, every week we do a market watch. We talk about other markets across the country that we think you should keep an eye on or not keep an eye on, depending on how they're performing. As far as what we specifically are monitoring right now, Nashville is absolutely number one because we're based here. Chattanooga is number two because we just opened up basically a branch of our operations out there when we bought the Newell Tower, a 9-story office tower downtown in Chattanooga's Innovation District. So we're actively looking to acquire more assets in the Chattanooga area to continue to hit critical mass there. I'm also very intrigued by Huntsville and Louisville. Louisville less so than Huntsville. I think Huntsville right now is the number one multifamily market in the country, just in terms of investor demand. And there's plenty of room to go build more apartments out there. So that to me is really interesting. At some point, we will look to expand into Chattanooga. Into Atlanta. Because Atlanta, to me, it's a great market. It's growing constantly. It has never stopped growing, which is really interesting to watch. So it seems to me like it doesn't really matter if you buy within a 100-mile radius of downtown Atlanta. It's going to eventually catch up there. And then, of course, I'm a big fan of Austin. I go down to Austin, Texas. I mean, outside of the pandemic, I go to Austin 3 to 5 times a year just because it's such a fun city. It's very similar to Nashville. It's got an amazing nightlife. The city is just really cool and beautiful. So, yeah.
On point 7, Puerto Rico, also another big market on our list.
Yeah, tell them about that.
Yeah, I mean, it sounds like a joke, but actually we are looking at some projects down here. I want to fly Kyler up here to look at one of them. We think me and my analyst team took a deep look into financials of one project. They do crazy things over here, like having 0% capital gains tax, 0% income tax, 4% corporate tax, and they give you like major tax credits if you invest in Puerto Rico. So it's actually a pretty cool market to look at that is, has all the advantages and benefits of investing in a US-based system, but also they get to set their own income tax rates because they're technically a territory. So pretty cool stuff.
Yeah, Andy on point is saying, "Yep, right in my backyard." Hey, Andy, will you check your mic real quick? Because every time you talk, I'm getting feedback. It sounds
Yeah, I'm
a little
trying to fix it.
Okay, so you're hearing it too, just making sure. Awesome. Okay, cool. Let's dive into this next one. So, New York company plans Dickerson Pike project after $9.26 million purchase. So, New York City area development company has paid a nice, pretty penny for multiple East Nashville parcels. And they have announced a large-scale mixed-use project. Let's see. It's an entity that is affiliated with Rethink Capital Partners, a company focused on undertaking socially responsible development that is based in White Plains, New York. I am a big fan of that, obviously. I mean, our company is also very focused on socially responsible development. We think that there is, the only reason that people don't like commercial real estate developers is because there are a small handful that have that don't take the neighborhoods into account and don't take into account the kind of impact that you really have when you're doing projects like this. So let's see. It's at 1410 Dickerson Pike. My project is 1404. Immediately, literally, we share an alleyway with them. At near the intersection of Dickerson and Douglas. Let's see. TTF Investments was the seller. They sold the bulk of the site, 27 acres for $8.75 million, and they paid $3.3 million for that land back in 2016 and 2017. Looks like another couple sold several other properties for $510,000. Let's see. It looks like they have also acquired some properties adjacent to the Just Spot site that have not yet been announced. Oh, look at that! They mention us. Dive Motel and the 2.97 acre site on which an LLC that includes Tyler Cobble sit immediately next door. We're doing the provisionary, which of course we did a whole video on that. If y'all want to look into it, you can just search East Nashville investment or something like that. I think that that video will pop up on the project that we're doing there. And so that's it for Nashville markets. Let's dive on into Market Watch. Last week we had discussed about how each of these markets that we've been looking at have always been positive. So I also do not look at these before Andy sends me the articles, by the way, because I like to kind of read through it and formulate my opinion as we're going. So I am interested to see if Las Vegas, which is the market that Andy has chosen for this week, is going to perform or not. So let's dive on in. Again, this is the Urban Land Institute's Emerging Trends in Real Estate. Highly recommend if you're interested in development or real estate investment, anything like that whatsoever. Highly recommend that you get involved with ULI. They do great things for commercial real estate. Okay, so they are the lowest overall real estate prospect that we've had so far on the list. They're coming in at 68. Most everything else that we've looked at was in the top 20. So this is interesting. They are in 68, which is the bottom. Let's see, there are more than one standard deviation below the mean, which means they're in the bottom third of the sites that are listed here on the U.S. markets to watch. They are number 74 in terms of home building prospects. If I'm building homes, I'm probably not going to be looking at Las Vegas. So I bet you can go ahead and guess that the metrics for Las Vegas are probably not that great. They are considered a niche market under the visitor and convention centers. So that also includes Cape Coral, Fort Myers, Charleston, Deltona, Daytona, Honolulu, New Orleans, Orlando, and Virginia Beach. And in terms of local market prospective investor demand, they are a 2.88 out of 5, which again puts them towards the lower half of the list. Now, look, they're not as bad as Detroit, which is sitting at 2.33, but they're behind Kansas City, Virginia Beach, Omaha. I mean, there's some cities in here that I wouldn't think would be very interesting that Vegas is behind. So that's interesting to see. Let's dive on into this 2021 Las Vegas real estate market investing forecast from Million Acres. See what we can kind of glean from that data. Las Vegas is most well known as the country's gambling and entertainment hotspot, but many people don't realize the city is seeing a lot of growth in other industries. Las Vegas has been attracting a number of businesses relocating from other cities and is also gaining popularity as a place for startups. Let's see. Oh, on point 7, sorry, I'm just now seeing your question. You're asking, what is it called? If you're asking about the development that we are doing, it's called The Provisionary. It's at 1404 Dickerson Pike. You could look up East Nashville investment opportunity, I think, on YouTube, and we did a whole video on it, kind of walking through the project. The project has changed a little bit, as developments tend to do, but that's kind of it for now. Let's see. So it'll be interesting. This article may take a more positive approach on Vegas. I would imagine that Vegas is doing poorly right now just because of, one, COVID, but two, the flight to the southeast and southern cities. There's probably not a whole lot of people that are really looking to move to a place like Vegas right now. Let's see. It's one of the sunniest cities in the country. It also has a very friendly business climate. Nevada nor City of Las Vegas have personal or corporate income tax. That's pretty big. The site EOI link that Andy sent. Andy, did you send a link over to?
What link? I don't know.
Okay. Yeah, on point. I'm not sure. I mean, if you go, let's just go to YouTube. If you just go over to YouTube, type in East Nashville investment offering, it's this one. So it's just investment offering, commercial development in East Nashville, 784 views. We put this together when we were doing our investor pitch, initially raising capital for the site. So you'll be able to go through that and watch Bruce Peterson and I, who's my partner, one of my partners on the deal, kind of talk about what we've got going on there.
Oh, he might mean ULI. Is that the one that he's asking what the ULI emerging trends report is? Yeah,
ULI. So that's Urban Land Institute. You just go to uli.org.
And look for their emerging trends document.
Yeah.
Yeah, that's it.
Yeah, the PDF. Yep, that's it. Urban Land Institute, uli.org. And they'll have all that information on there. Also, there should be links below in the description. Let's see here. Okay, so let's see. The famous strip only makes up a very small piece of Vegas and doesn't actually represent the lifestyle and culture of the people who live there. I would hope not, because Vegas would not be a very big city otherwise. Let's see. Okay, unemployment is still high. While casinos and resorts are beginning to back up or beginning to open back up, and the number of travelers heading out to Las Vegas is slowly increasing, the unemployment rate is still quite high. I'm sure we'll get into the numbers here in a minute. Rental vacancies are low. Despite the high unemployment rate, rental vacancies have been trending downward to record low rates. That's a great sign. This shows a growing demand for rentals in the area and a positive sign for investors. Rental prices are also up as vacancy lowers. I mean, look, it's supply and demand, right? If your vacancy is decreasing, your costs are going to, cost is going to increase. This has been a positive trend since 2016, and prices are increasing at a faster rate than the national average. Interesting. Okay, wow. Unemployment is 9.9%. That is really high. That is really, really high. National average is 6.3% right now. And I think Nashville is down to like 3.9, give or take. I mean, we're pretty low. So, that's rough. Median price for a house is $322,000. That is, I believe, that's above the national average. Yep, definitely above the national average. Median rent price is $1,508 per month. Let's see, they've got a 1.7 month housing supply, so that's pretty healthy in terms of, if you're going to be buying and investing in Las Vegas. A typical healthy housing supply is somewhere around 4 to 6 months, give or take. So if you're at 1.7 months, that means demand is still high, which, is good to see. Rental vacancies down to 2.9%. That's really strong. I mean, that's really, really strong. That's basically, people are moving across the street at that point. All right, let's go into this next article from Forbes. Are Vegas home prices sustainable? January real estate summary. Let's see. Las Vegas home prices have reached all-time highs during the pandemic. This has happened despite an unprecedented. Wow, I am not able to speak today. Pandemic-related recession, with unemployment reaching an all-time high of 34.2%, still sits at roughly double the national average to this day. While housing has grown more unaffordable for most over the past year, it's luxury Vegas real estate that has been driving the market. Interesting. So uber luxury real estate. Las Vegas and Southern Nevada has not only blown away records on its luxury market for 2020 that are up 38% for $1 million and above, but the uber luxury market of $4 million plus has hit heights never seen before in the valley and doubled its performance from 2019. So
Doubled.
Yeah, that's pretty remarkable. I mean, look, you want to take a guess at what that is? It's people from California who are selling out and going to the nearby state that has no state income tax. I mean, they've got a lot of money to spend and buy nice houses. In December alone, let's see, 129 homes priced $1 million and above changed hands in Southern Nevada. That's insane. $129 million worth of real estate, of luxury real estate, traded in December. That's pretty remarkable. Let's see. Low interest rates, along with the pandemic-related and remote work-related exodus from coastal cities like San Francisco, Los Angeles, and New York, are contributing to these factors. Housing and unemployment rate tend to show a strong inverse relationship, of course. Like we said, unemployment rate was high. Housing is very low. Nevada's number 8 in terms of property taxes. Number 1 is, so this is ranking 1 to 50. Number 1 is the best. 50 is the worst. That's surprising. Texas is 37 and Tennessee is 29. How's that even possible? Property tax component rate. That's really interesting because Tennessee has a great tax structure, but I guess it's taking into account something else that I just do not know about. Utah is number 3. That's great. New Mexico, number 1. California's only 14. I have a hard time thinking that Tennessee has a worse tax structure than California. It's just property taxes.
On
let's
property
keep that in
tax
mind.
only.
Yeah, let's keep that in mind. So, property taxes are, at the end of the day, not the biggest taxes that you're going to be paying anyway, right? So, let's keep that in mind. Wow, Indiana, look at that. Illinois is 45. That's why people coming from Chicago love Nashville so much. Oh, let's see here. House price trends do not match the current economic climate in Vegas. The price growth is not sustainable, says Mashvisor. So it's very likely that home prices will drop in the Las Vegas real estate market in 2021. That's not good. Let's see. CoreLogic, which showed a 6.4% increase in Vegas real estate year over year in 2020, predicts a 6.5% drop by August of 2021. But that view is not universally held. That may be probably on the more aggressive side of people thinking that prices are going to drop. That's interesting. You've got some factors that are saying Vegas is a good market to invest in. You've got a lot of factors that are saying that it's not good to invest in. Look, the positives that we just talked about were all on the uber luxury side of the real estate there, right? And they're already saying that those are not sustainable. So, to me, I would probably be staying away from Las Vegas as an investment, as an investable market at the moment. But you're welcome to formulate your own opinion. Concise the Barber just says, PA does not surprise me. Where is PA? Number 30, is it 34 or 31? Either way,
below
really
average.
High. Yeah, either way, below average.
I was going to say, Tyler, just wrapping up this point is that we've seen, across every market, the luxury end is actually doing well, especially in areas that are not named California yet, because people are leaving. The end. They had a lot of money and now they're leaving. And so the places that they're moving to are doing well. Great. But it's hard to sustain that in the face of 10% unemployment rate, right? When Las Vegas will never be the same, right? Las Vegas is specific, not just Nevada, it's Las Vegas, right? So Las Vegas will never be the same until all these casinos are at 100%. Period, right? And all the business conventions that they have to cater to, all the huge events. And that might be coming back end of this year, next year. But it's going to take a while, especially when you have, and I looked up Nashville's unemployment rate, it's at 4.2 right now. So Las Vegas unemployment rate is 2.5 times Nashville's unemployment rate. It's just night and day, and it's really, really hard to invest in a place when your workforce is having which is the base of the economy, right? The luxury stuff is good,
Right.
but the workforce is the base of the economy. And if the base of the economy is doing bad, then it's going to affect everything else.
That's exactly what I was going to touch on, but you nailed it. I mean, look, if the workers who really drive Vegas, right? Because you've got to have all of those people that are there, turning the rooms over, that are running the casino, they're bartending. I mean, if they're unemployed, they're not doing well. I mean, the market overall is just not going to do well. It's just how it is. All right, let's move on to the future of commercial real estate. So this first article is from Business Journals. Many small businesses are having trouble paying rent, and customers aren't returning fast enough. Let's see. Oh, we got a question about Vegas real quick from Big Show Entertainment Network. Hey, man, what's going on? The Vegas housing market was down prior to the pandemic. Interesting. So, yeah, I mean, do you have anything else that you could add to that? It'd be interesting to have that conversation. But, yeah, I mean, Vegas is such an interesting market anyway. It's such a niche real estate market. I would be a little wary of it regardless, because I mean, I know that the last article we just read wanted to claim that, hey, this isn't the only thing that's going on in Vegas, right? The Strip is not all of Vegas, but that is the majority of what Vegas is. I mean, it just is, right? The Strip, the casinos, the lifestyle. So,
Tyler, let me bring my friend who is working out of Vegas real estate market onto the show. She has a lot of thoughts and opinions, and she makes a lot of content about why she thinks Vegas is good. So I think she would be a good interview guest. I'm actually going to email her right now.
Yeah, that'd be a lot of fun. Let's have that conversation. See what her thoughts are on Vegas. Okay, diving back in. So we're talking about small businesses are having trouble paying rent. Customers are not returning fast enough. Let's see, more than half of minority-owned small businesses and more than a third of small businesses overall said that they had trouble paying rent in June, and customers are not flocking back fast enough as COVID-19 ebbs. This is interesting because we're seeing pretty much a Big Show Entertainment saying Vegas is unlike any other market in the country. It really is. I mean, it's such a niche market. Let's see. But yeah, this article is interesting because I mean, we've kind of experienced the opposite. I mean, we've collected 100% of our rent since COVID happened. I mean, we got out there and helped our tenants as quickly as we could, but everybody's really been doing fine since December, maybe even earlier than that. I mean, Nashville really opened up back in December. I mean, I just remember going down to Broadway and you're like, wow, it's like COVID never happened back in December, which is kind of crazy. But, I do also have to take into account and remind myself, like, Nashville is a very different market. The rest of the country is not necessarily like this. Let's see. Findings come from a survey by small business network Alignable, which recently polled 3,800 businesses about their rent status. 53% of minority business owners said they had trouble paying rent in June, up 8 percentage points from May, and disproportionately higher than the 37% of small business owners overall who reported having trouble paying rent. That's interesting. I wonder why they were affected so disproportionately. Okay, well, here we go. One word answer is access. Greater access leads to greater outcomes, whether it's access to financial resources, business services, suppliers, or other business owners with whom one can network. And minority-owned businesses have never been working on a level playing field, Alignable CEO and co-founder Eric Grove said. He pointed to reports that minority-owned business owners also had trouble accessing the popular Paycheck Protection Program, being rejected at a rate of almost 2 times that of non-minority businesses. How is that even possible? I mean, that's ridiculous that that's even a stat. I mean, that's crazy. Sorry, that just threw me off. Rejected at twice the amount of non-minority businesses. That's just... Sorry. Concise the Barber's jumping in the hair industry, barbershops and salons, I haven't noticed much struggle. However, new leasing seems to be outrageous if you're looking for a new location right now. Yeah, that's true. I mean, if you're anything like Nashville, I mean, prices have only gone up, right? I mean, and vacancy has gone down. It's impossible to find another space. I mean, businesses are doing well. And there's also businesses that are leaving these other cities and coming to places like Nashville. We're working with a lot of them that are relocating here because They got shut down in California, or they got shut down in Chicago, and they were, look, we can't survive if we don't have a business. We've got to move somewhere and open. So it's really interesting. It shouldn't be surprising after over a year of intense financial impact on business owners that those who had difficulty accessing the financial lifeline provided to get businesses through the crisis would be in a worse financial position exiting the crisis. Well, of course. Rent challenges have big implications for the commercial real estate sector, which is adapting to a new normal in the office and retail sectors. Let's see. Industries with biggest difficulties paying rent in June included construction, transportation, travel, beauty, and entertainment, with 40% or more businesses having trouble in those industries. It's really interesting because construction wasn't even really shut down as an industry during the pandemic because it was deemed essential, unless you were, of course, New York or wherever, they just shut everything down. But I don't know. It's weird reading articles like this. Honestly, it's weird going through stuff like this and then looking at it from the Nashville lens, right? Because we have not been affected like this. And maybe it's because of our leadership. Maybe it's because Nashville is just one of those markets that is fortunate enough to be in whatever bubble it's in, because we also didn't experience too rough of a downturn back in 2008 either. But it's crazy to see that this is still happening around the country. We're optimistic we will see more growth there as we get deeper into the summer, but clearly the climb back will be harder and more challenging for minority-owned businesses who found less support resources over the last year. Let's see, trouble stems from a lack of customers and rising supply costs, which 55% of small business owners say have hit their bottom line. 48% of small business owners say they have half or fewer customers than they had before the pandemic, and 57% report having half or less the monthly income than they had before COVID-19. I mean, of course, if you're not making that much money, it's going to be really tough to recover. Right? I mean, and pay your rent and deal with all that kind of stuff. So let's see, 55% of small business owners are finding it more difficult to hire workers than before the pandemic. That's absolutely true across the board. I mean, I've got buddies that own hotels that can't hire cleaning staff. They're actually having to block off entire floors from their hotels because they can't get anybody to clean them. 34% say it was significantly more difficult. 46% of small business owners said employee costs have risen. I mean, that was inevitable. 24% saying that they have risen by at least 11%. Okay, well, now we're just getting into me reading off percentages. Anyway, that's interesting. So, yeah, I mean, it looks like, unfortunately, minority-owned businesses have been affected way worse by the pandemic than others. I don't know. I don't know what to do about that. I wish that there was, I don't know. I'm going to think on that. If you're a minority that owns a business and you need help, reach out. We're happy to talk to you. And I'll help you have a conversation with your landlord or do whatever if you need it. Okay, moving on. This is Globe Street. Landlords frustrated as CDC extends its eviction moratorium. Instead of ending in June, the moratorium on tenant evictions now stretches through July 31st. Landlords have been frustrated by this since the very beginning, right? And I understand why you would want to do it. You don't want people getting kicked out in the street in the middle of a pandemic because of people can't pay because of circumstances that are completely out of their control. However, there are plenty of people that are taking advantage of the whole situation. They're not paying rent intentionally, even though they can, because they're getting by with these programs. And of course, in every situation, you're going to have people that are taking advantage of whatever's going on. But it's got to be incredibly frustrating for residential landlords dealing with that. Now, that's one of the reasons why I'm very happy that we are not diversified into residential. Because you don't have that problem with commercial. I mean, look, it's you own a business. You're not going to pay rent. Get the hell out of my building. And most judges kind of take that same approach. Let's see. July 4th may be Independence Day, but landlords were counting on June 30th to end the COVID-related housing eviction moratorium. Now they have to wait another month. The CDC announced an extension through July, which is intended to be the final extension of the moratorium. Little little consolation to investors and operators of residential rental properties. I mean, of course it is. The continuation of a nationwide one-size-fits-all federal eviction moratorium is out of step with the significant progress made in controlling COVID-19 and restoring the economy. I mean, you'll get a city like Nashville where it's booming, people are back to work, everything's been basically, normal for all intents and purposes for the last 6 or 7 months. It doesn't make any sense to have an eviction moratorium here because you don't have a job because you don't want one at this point. Here, that's at least that's what I think. Multifamily landlords and managers have operated throughout the pandemic with a flexible and compassionate approach for residents in need, which is great. I mean, that was one of the best parts to see when we first entered the pandemic was that people were working together to make sure that you just weren't kicking people out on the street. I mean, of course, there was a moratorium immediately, but even on the commercial side, we worked with everybody as much as we could. This has obviously been an extremely trying year, plus for the entire sector, with the lack of clarity on when the moratorium will ultimately end. I do expect landlords to continue working with residents with the ultimate goal of avoiding evictions wherever possible. Most landlords, I don't know a single landlord who would take an eviction if there were better alternative routes. I mean, nobody wants to go through all of that just because it's such a pain. Andy, did your roommate find some mulatto?
Yes. Well, no. There's apparently a story.
I can tell because you keep laughing. So before the show started, Andy's roommate was trying to learn how to say "I would like some ice cream, please" in Spanish, and I would imagine he didn't say it right. Let's see here. Paul Getty, CEO of First Guardian Group, which provides services for real estate investors, including many mom and pop owners, tells GlobeStreet.com these are the people that have to pay the bills, and in some cases are close to bankruptcy because the tenants are not paying. What's being reported to me is that the tenants in many cases are doing well. They're using COVID excuses for not paying rent, which is creating a lot of pressure on many of our clients to sell properties. This could be a complete aside, but one of my buddies he pays cash for everything. And he was at what's that place called? I don't know. He went to a place where you could buy hot tubs in Nashville. And the guy asked him if he was going to finance the thing. He said, no, I'm just going to pay cash. And he was like, how many people finance a hot tub? And he goes, almost everybody that comes in here and buys a hot tub finances the hot tub, which, if you know anything about money, is one of the worst things that you could ever do with your money ever. You're financing a depreciating asset that will literally not improve your life by so much that it's worth taking that risk on. And the guy said that the majority of the people that are buying hot tubs are using their COVID-19 checks, which I thought was really interesting. At least it's going back into the economy, though, right? Hey, serving part of its purpose. While there has been relief money available to pay rents and keep tenants in buildings, access has not been simple. The problem is an easier problem to digest if you're a larger property owner, of course. I mean, that's why I'm a huge advocate for multifamily over single-family residential, because if you've got a 200-unit apartment complex and 20 people move out or 20 people stop paying because of COVID, you're going to notice it, but it's not going to be absolutely devastating to you where you're going to be on the verge of filing bankruptcy. Let's see. In some areas, the extension of the moratorium won't be the last hurdle for landlords. In addition to being precluded by the CDC moratorium for pursuing the eviction of covered persons, New York landlords are also prohibited from pursuing eviction of tenants who submit a hardship declaration as governed by New York legislation, which stays eviction proceedings until August 31st. I don't even know what that is. I don't even know how you would want to get into being a residential landlord in Manhattan or in New York City in general. It sounds terrible. Sounds absolutely terrible. Okay, cool. This next one is also from Globe Street. Small cities poised for a rapid retail recovery. I'm a big fan of retail, always have been. Retail did really well through the pandemic if you were keeping an eye on the right kinds of retail. Big box, of course, has been dying a slow death, which it deserves. But all the other retail's doing great. The population out of major metros during the pandemic will likely create a heyday for the retail sector in smaller cities. Look at that. Small cities that have benefited from population growth during the pandemic are also poised for a rapid retail recovery. These metros include Nashville, Austin, and Charlotte, and they are seeing increased retail leasing demand from both national and mom and pop tenants. We've had a ton of people that are moving here from other cities that are just tired of it. It isn't only population growth driving the demand for retail. Major companies are also expanding in the Southeast. Amazon and Oracle have announced plans to open offices in Nashville and Austin, and Apple is expanding in Raleigh. I mean, Oracle just announced 8,500 jobs and a whole campus a few weeks ago. These smaller markets are attractive to smaller companies. What? Those are not smaller companies. Employees can have a shorter commute and can own some land or a house in case something like the pandemic happens again, and they are working from home for 6 months or a year. That's fair. The population and job growth stabilized smaller metros through the pandemic, so few saw the retail tumble that occurred in major metros. In Nashville, for example, we didn't seem to have a slowdown, especially on the development side, as what we saw in some of the bigger markets like New York or Chicago. That's absolutely true. I mean, if anything, it picked up. We put under contract some of the largest development deals we've ever done in 2020. We continue to have an active 2020 for development, and I think that is part of the strength of the market as well. That's Jeff Pape from GBT Realty. Let's see. New retailers are expanding into these markets. Let's see. Urban mixed-use product type that had never looked at Nashville before. Certainly some of these are new retailers that are used to being in that kind of product type. That's interesting. Concise is saying Charlotte seems to be booming. There seems to have been booming for about 10 years now. Absolutely. I mean, Charlotte's a great city. It's definitely on the watch list. I would keep that in your radar if you're interested in investing in any cities in the Southeast. I mean, it checks all the boxes for me, which is it's a progressive blue city in a red state, right? Like, to me, I don't know that there's anything. I mean, every city that we feel is worth investing in is a blue dot in a red sea. I mean, I don't know of a single one that's red and red or blue and blue, or even a red city in a blue state, now that I think about it. So, yeah, I mean, look, if it's a blue city in a red state, that automatically is, checks the box of, yeah, we should probably look into this. Let's see. We're seeing more and more that there are national tenants, and then you drop straight down to mom and pops, and we're seeing that trend more. So what they're saying is you're starting to see these national tenants that are immediately next door to mom and pops, which you haven't really seen before. Typically, the shopping centers have been split up to where there's like mom and pops over here, and it's a cheaper, not as nice looking shopping center, and then you have the national guys over here, which to me has always been so backwards because it just automatically makes you think that national retailers are better than your local shops, and that's not the case. I'm not going to say it's not the case in every case, but like it's just not true. I mean, there are plenty of local groups that are way better than anything national. So it's good to see that, we're starting to kind of mix those up. There are many opportunities in the Southeast. Awesome. Cool. Well, let's jump into, and do you have anything else you want to add on to that? Rock and roll. All right, let's jump on into private equity deal dive. So this week, we are going to start off with Blackstone betting $6 billion on buying and renting homes. This is an article from the Wall Street Journal. If y'all have been following me for a while, you know that I'm not a fan of single-family home investing, but these massive REITs are. And I think that their approach to it is probably why it's different. Because, look, they're buying these massive portfolios. They're able to get them financed like apartment complexes, which I think is really interesting, which means they get better debt terms. And, when you buy a portfolio of 100 homes, I still think that it's not as good as having a 100-unit apartment complex, but it's a totally different product type, right? I mean, at that point, you can't really compare it. It's like comparing, multifamily and office space. They're just different ways of collecting money. Deal for Home Partners of America, owner of over 17,000 houses in the U.S., as latest sign Wall Street believes housing market will stay hot. Blackstone Group, Inc. has agreed to buy a company that buys and rents single-family homes in a $6 billion deal. The investment firm confirmed Tuesday that it has reached a deal to acquire Home Partners of America. Again, that's 17,000 homes. They buy homes, rent them out, and offer their tenants the chance to eventually buy them from them. That's interesting. U.S. home sales soared last year in their fastest pace in 14 years. When low mortgage rates and the rise of remote work during the pandemic sent buyers scrambling to find larger living spaces. The lack of homes for sale, I mean, look, you can't build homes fast enough to accommodate the demand right now. I mean, Nashville alone has a gap of, I think, 30 or 35,000 affordable units by 2025. I mean, it's a lot of units. You just cannot build fast enough. It's slowed the pace of home sales in recent months, but on a historic basis, the market seems or remains red hot. And analysts say demand from millennials entering their prime home buying years is expected to fuel demand for years to come. It will be interesting to see what will happen as millennials enter prime home buying years. I mean, millennials have really paved the way to make renting cool, and all of the benefits that come from that. So it'll be interesting to see what goes on there. But I mean, look, that's a massive deal. I mean, Blackstone is one of the largest investment groups out there, if not the. I mean, yeah, they're definitely one of top. And for them to be jumping in and buying these multi-home portfolios like that is a pretty big sign that, home renting is here to stay. So the residential market is still hot. And also, buying these massive single-family home portfolios is still worth looking at.
And they bought it in cash, too. So imagine sitting on just $6 billion just casually.
Yeah. Yeah, let me just go get that. It's under my mattress.
Mm-hmm.
Oh, that's crazy. But I mean, hey, look, that's another sign too, right? I mean, a lot of these firms were sitting on a whole bunch of cash going into the pandemic. They didn't have nothing popped up that they could buy. There were no distressed assets that came available for sale. So now they're sitting on all this cash that they still have to pay a return to their investors on. So at this point, that's why you're seeing all of these acquisitions, all of these mergers. They're doing anything they can to just get more market share. It's really interesting to watch. Okay, this next article is from Commercial Observer. First Key Homes nabs $2.1 billion loan on more than 9,000 single-family rentals. It'll be interesting to see if Andy's WILDCARD has anything to do with single-family rentals, since he's loading up our private equity deal dive with him. No, it doesn't? Oh, interesting. Single-family rental housing market accelerated last year amid the pandemic as climbing home prices pushed many to fall back on renting. Investors poured into the space, and rental home construction ballooned in 2020 to meet demand despite a turbulent economic landscape that created supply chain issues. Yeah, I mean, construction prices, construction's ridiculous. If you've been looking at building or, constructing anything in the last, 15 months, it's just not possible to hit. I mean, the numbers are so crazy that we're exploring alternative construction methods, and we feel that we're going to hit those at a better price than, or as almost like within the same ballpark as what it would have cost to do lumber, which is crazy because they used to be so far apart that it wasn't worth doing. Let's see. Already this year, there have been 11 single-family rental CMBS deals, accounting for more than $6.7 billion that have either closed or are near closing. That's crazy. Single-family rental securitizations, which started to gain steam in the early 2010s, have characteristics of both CMBS and residential mortgage-backed securities deals. I'm probably not going to dive into that because that would get really complicated, but basically what this is saying is, wasn't all that long ago in 2014, Kroll Bond Rating Agency developed a methodology for rating single-family rental securitizations just 1 year after the single-family rental securitization went to market in 2013. So let's see. First Key Homes has secured just under $2.1 billion in CMBS debt on a collection of 9,328 rental homes. The deal, which is First Key's third single-family rental securitization, is expected to close on July 15th. Morgan Stanley is the lender that originated and sold the 5-year fixed-rate and interest-only first lien mortgage loan. So, you look at that, that's a multifamily deal, right? That is not your traditional single-family home investment kind of offering. You can't really get terms like that, which is really what makes these so attractive. Portfolio includes homes that are located across 16 states, with the Atlanta, Miami, and Charlotte areas being home to more than 31% of the portfolio. Florida, Georgia, and North Carolina account for 56.5% of the portfolio. So look at that. Southeast. It's all about the Southeast, baby. Despite the pandemic, the recession-resistant reputation, say that 3 times fast, of single-family rentals mostly held up for the portfolio. Nearly 93% of rents were collected in May, and about 96% were collected in April, with, 90-day rent collections, which includes collections that were had up to 3 months after they were first billed, ranged anywhere from 94.4% to 98%. I mean, look, they're doing well, right? They're doing really well. So let's see. Keep an eye on, these residential real estate portfolios. There are REITs out there that you can invest in that buy this type of product if that's something you're up for. All right, let's dive on into PropTech. Let's see what we got going on for us this week. CNBC, 3D printed housing developments suddenly take off. Here's what they look like. I love 3D printing houses. I love alternative construction methods. There are so many ways that are more efficient to build homes and to build buildings than what we've been doing for the last 50 years. So it's great to see that there are groups that are finally really taking this on. Icon, a pioneer in 3D printed homes in the U.S., just completed 4 homes in East Austin, Texas. The 2 to 4 bedroom homes are now on the market, starting in the $400,000 range. A much larger community of 3D printed homes is being planned in Rancho Mirage, California, by competitor Mighty Buildings. Cool. Let's see. The first home that went up for sale hasn't even been built yet. The company, SQ4D, printed a model home at a concrete yard on Long Island, New York, and hosted more than 100 showings. The new home will be printed on a lot nearby. That's pretty cool. Let's just build a house to see if it works. What a cool product to test. Let's see. Icon, a pioneer in 3D printed homes in the U.S., just completed 4 homes in East Austin, Texas, in partnership with Kansas City-based developer 3 Strands, starting in the $400K range. Demand has been off the charts, hard to manage even. Feedback could not have been more positive. City of Austin, one of the fastest growing metropolitan markets in the country, has already embraced the concept of 3D printed homes, so zoning and permitting was relatively easy. I mean, that's one thing that is really tough when you're doing these prefab or modular or 3D printed homes, is local zoning and codes regulations, right? I mean, typically when you're going through the building process, you have the inspector come out on site multiple times to inspect various aspects and stages of the construction so that they know that it was built right? So, if you're going to do that in a different way, how are you really going to monitor that? We built 4 homes in the configuration we did because we could do it within the existing zoning. It's pretty cool. All right, let's get into how they're made. Icon prints the homes on site using its Vulcan construction system that spits out a proprietary extrudable concrete, according to Ballard, who added that this is the highest speed, lowest cost method. It also allows for the most flexibility in floor plans. Let's see. At the new development, Icon 3D printed the first floor and then built the second story conventionally, but that allowed them to certify the wall system for 2-story construction. It's the quickest path from imagination to built options. So you can see there's an image of it. You can see, the lines and the concrete there. And they just built on top of it. I wonder why they wouldn't just print the second one. Big Show is saying smart homes are extremely cool. The problem is transportation of the homes. You're absolutely right. I mean, that's one of the biggest expenses in these pre-manufactured homes. We've been doing this a lot, trying to dial it in for a project that we're doing. And it's expensive. I mean, what does it cost, Andy? Like 16 cents a mile or something like? What was the cost they said to factor in for that?
Yeah, to ship something from North Carolina, it was like $15,000, something like that, $20,000.
Yeah, so when you're talking about a $200,000 piece of or building, and
And
you
that
can
was for
add on.
one module of it, right?
Yeah, yeah,
That's not, everything together.
that's right. So, 15K a unit, that's almost 10% of your price, right? It's a lot. Ballard said construction of the homes is 10 to 30% cheaper and several months faster than conventional construction. This is especially important given the rise in building costs and conventional construction materials like steel, aluminum, and lumber. Let's see. Sustainable. The materials are so much. They're just as good of materials to build buildings out of. Look, when you start looking at the housing crisis, the affordability crisis, to me, there's no way that we're not going to move very heavily into this. So the groups that are investing in it right now will do really well over the next 20 years. I mean, think about it. Can you imagine walking out on a job site and you go out and you clear the land, and then the next day there's just a printer that gets set up out there, and there's a technician that's watching it print 50 homes. I mean, it'll be amazing to just watch that happen. So it goes into a little further into the design, some of the looks, the aesthetic appeal. I mean, they look like normal homes. You wouldn't think anything of these, right? I mean, that concrete is much more efficient in terms of, insulation, all that kind of stuff. So that's cool. I mean, it's really great to see that this is finally starting to happen. It's definitely not at scale, right? But you've got 4 homes that have now been 3D printed in Austin. It's really cool to see, and relatively affordably. I mean, the median house in the United States is $260, give or take. The median house in Nashville is $350. So for these to be $400,000 houses and they're 2 to 4 bedrooms, in Austin, Texas, which is a hotter market than Nashville, doesn't seem like a bad price to me. But all right, let's go ahead and move on into reading REITs. Now for real estate investment trusts. This week, we're going to be diving into cell tower REITs, all in on 5G. 5G has and will continue to have a major impact on these REITs. So let's see how that has started to impact the sector. Cell tower REITs, the single largest REIT sector, I didn't know that, are again pulling their weight after uncharacteristically lagging earlier this year, catalyzed by strong first quarter earnings and major mergers and acquisitions developments. AT&T and Verizon ended their tumultuous foray into the media business this year, divesting their capital-draining ancillary businesses as competition has heated up with T-Mobile and Dish Network. Wireless network spending is poised to accelerate as the 5G rollout advances. All 3 cell tower REITs boosted their full-year guidance during earnings season and now expect double-digit FFO growth. Wow. Cell tower REITs remain in growth mode, utilizing a sector-leading cost of capital and favorable competitive positioning. American Tower acquired $15 billion in additional assets in early 2021 through 2 major deals. While no longer cheap, cell tower REITs should remain a growth engine of the real estate sector, and risks to technological disruption remain distant, particularly as carriers go all in on 5G network buildouts.
I want to go, Tyler, there's the next chart. Yeah, that one. I think that's kind of interesting, of just like essentially 3 companies own all the cell towers and 3 companies are all of the wireless carriers in the United States. So it's just a huge monopoly on this stuff.
That's really interesting. I wonder why that is. I mean, I know it's obviously there's a lot of red tape you've got to cut through to make this happen. But I mean, so if you're listening on the podcast, cell tower ownership is American Tower, Crown Castle, and SBA Communications, with other making up 25%. So those 3 take 75% of the market. On wireless carriers, AT&T, Verizon, T-Mobile make up 95% of wireless carriers, with Dish making up the other 5%. So, I mean, you look at that, and it's, 3 in each sector dominate almost completely.
So apparently the most important thing is that all these companies are going all in on 5G. So we can skip to 2 charts from now. So not this next chart, but the one after that, actually, of like what 5G does. I don't know if you can zoom in a little bit, but
Yeah.
essentially the point is that 5G is supposed to be like 10 to 100 times faster. It's going to have almost no lag at all. You can have way more devices, but the problem is that you don't get as much range. So if you look at kind of the tower on the left versus the one on the right, that's from 3G to 4G, and then you started needing more equipment and stuff. From 4G to 5G, you need even more equipment. So the theory is we're going to 5G. It's going to be a billion times faster. You're going to be able to stream 4K or whatever is after 4K, 8K. I think there's 8K now. You can stream 8K over your phone in like 5 seconds. That's where we're going, which would be kind of cool. But in order to get there, you're going to need to way increase the amount of cell towers you have. And so you think about it, that's actually a big problem. Like you think about downtown cities or in places to put these, there's not a lot of good sites and spots to put cell towers. So it's just kind of one of those things you don't really ever think about, but it's actually going to be huge in trying to figure out where the real estate for these cell towers are going to go in order to support the infrastructure for 5G.
Yeah, unfortunately, a lot of them can go on top of existing buildings. So, like, they'll call shopping centers and office buildings in areas that, because, I mean, that's that's real estate that's not getting utilized. So why not throw it on top of a building like that? But, yeah, I mean, for the larger ones, I mean, they need a lot of land, right? So it's tough to figure out how you're going to solve that problem. Cell
So
tower
all
growth.
the rest, I think the most important, we can just go down. They have
Go
the
down to the
bullish and
bullish and
bearish.
bearish.
Yeah.
Cool. This is from Seeking Alpha, by the way. These links are in the description below, of course, if you are interested
It's
in
above.
seeing. Oh, it's further up. If you're interested in diving
here.
further into this. Yeah, here we go. Okay, 5 reasons to be bullish on cell tower REITs. Mobile data demand. I mean, of course, look, mobile data is only going up. We're only using more and more devices that are connected to it. Hub of 5G. Macro cell towers provide the most economical mix of coverage and capacity. Pricing power over carriers. Cell tower REITs have strong competitive positioning in the communications sector. More than any other real estate sector, asset ownership is highly concentrated. I mean, yeah, it's almost what is a triopoly?
Triopoly.
Yeah. Network densification. 5G is all about that. With significant operating leverage, 5G related equipment upgrades and adding tenants to existing towers produces significant revenue with limited costs and international opportunity. Wireless internet is the only option in many international markets which lack the landline infrastructure. So those are 5 reasons to be bullish on cell tower REITs. Now here are 5 reasons to be bearish. Technological obsolescence. While there's little risk of technological obsolescence within the next decade, technologies like low-orbit satellite or small cell networks could potentially reduce the need for macro towers, like Elon's, Starlink or whatever it's called.
Yeah.
I mean, if that gets solved, then these are completely obsolete. Tenant consolidation. There are only 4 major players in the U.S. carrier industry, including Dish Network, limiting the number of potential tenants for these REITs. Carriers want to reduce costs. Cell companies pay 20 to 30% of their revenue towards these tower companies, and carriers are actively seeking ways to gain leverage over these REITs, including building their own towers. Lack of land ownership. REITs own less than 30% of the underlying land and lease the other 70% under long-term ground leases. So competition from carriers or other tower firms could bid up prices upon lease renewal. And international risk. American Tower's struggles in the India market highlight the uncertain political and operating environment in many international markets. So high potential growth comes with high potential risk. So there you have it for cell tower REITs. I mean, Andy, are you bullish or bearish?
I'd probably be bullish. I think that there's the case is we need more cell phone stuff. The end. And we don't have enough, and people are going to want way faster speeds. It's like, I definitely want 5G internet, and that's going to be able to solve even in just the United States alone, so many internet problems, right? Having 5G. So for especially rural places that don't have broadband. So I think it's going to be coming. I think it's going to be huge.
Yeah, exactly. I mean, I completely agree. I'm bullish too. I mean, I don't diversify my portfolio with REITs. But if I did, I would definitely have cell tower in there. Look, I mean, we're not using any less data. I mean, every day we're using more and more. And even if something like Starlink comes along, how long until it is capable of managing the just sheer volume of traffic that they have to have on there? Anyway, awesome. Well, time for our favorite segment of the week, Wildcard. Andy, when are you going to come up with a jingle for this section?
We can do a little dance. We can make a little song. That's going to be coming up next, guys. But thank you so much for sticking around to the end of the show. Every week we bring you live at the Commercial Real Estate Investors Weekly podcast all the best and top real estate news. At the end of each show, I cover on the wildcard section something cool, interesting, different about real estate. And in this case today, we are going to be talking about real estate, except it may not be so real. This is virtual real estate. And this article here, people are paying insane amounts of real money for virtual real estate that you can't even visit yet. So welcome to the future, boys and girls, where essentially, due to things like you may have heard of a little thing called Bitcoin and the blockchain, you are allowed to invest in these platforms that essentially allow you to buy virtual real estate. So as good, real estate investors and developers, I thought we had to bring you guys one of the next frontiers potentially in real estate development. So as this article says, a plot of land that you can call your own, a couple thousand square feet of untouched soil, trees and all, where you can let your imagination run wild. A dream come true, right? Well, sort of. This is virtual real estate and you can't even visit it yet. Where you can buy in places like Genesis City plots of land for like $200,000. Wow, that's a lot of money. By 2020, people have estimated already virtual reality and augmented reality are predicted to rake in an estimated $162 billion in revenue. Already a pretty big sector even before COVID, right? So one of this big companies that does it is this company called Decentraland, and allows you to essentially buy land, cryptocurrency, and parcels of land on there, and you can build homes, you can build houses, you can build a casino, watch music, attend a workshop, shop with friends, start a business on this virtual reality platform. And if you build up a nice building, you can then sell to somebody else who will pay you more money for it, just like in real life, right? And it's hard to believe that this is real, but it is, right? People are willing to pay money for it, and at the end of the day, what is valuation but what someone's willing to pay for it? So with NFTs taking off, and what NFTs are non-fungible tokens, essentially just means a way of tracking using blockchain technology whether or not you own something. And the real estate market buffeted by COVID, virtual worlds like Decentraland could be well placed to capitalize. So Decentraland, as we've talked about, is a role-playing game that is around a city called Genesis City, and you're allowed to go in there, you do stuff, you buy land, and look at this price appreciation. In 2017, the year Decentraland launched, land parcels sold for USD $100 per parcel. In 2019, a portion of the Genesis Plaza estate, called Estate 331, sold for $80,000. Okay, so that's $100 to $80,000 in 2 years. Not bad. The last month, the price of an undeveloped parcel of land had increased to roughly 8,000 mana, a 14-fold increase in just 3 years. So 14x return, 3 years, not too bad either. Since the game's launch, there have been more than 50,000 secondary land sales, totaling $30 million at an average price of $560. So that is pretty crazy. This virtual real estate is going to be increasing in popularity, and I wanted to show you guys here as well. You can even see, like, this is the games on Decentraland where people are just going in to hang out. You make your little character and you buy your land. You can go on there. We can buy this parcel right now, parcel -3810 for 8,700 mana, and I think they're about 50 cents each. So they're this thing is $4,000 right now. And then apparently there are other things you can buy. You can buy, if it will ever load, you can buy houses, you can buy estates, you can buy exactly as they said. Let's see, super rare one, and then this one's costs like way more, 12,000, man. This one's a fashion estate. Oh, you see that? This is one block. This one has 2 blocks. Pretty crazy. So the point I wanted to bring up here is looking at all these pictures is real estate is a function of location and supply and demand. So why not in virtual reality as well? That's could be something that, especially if you don't have all the money right now to go big on real estate, as long as people want it, as long as people want it, that's where the money's going to be. Every real estate market is local. We've been talking about it all throughout the show. Places like Las Vegas versus Nashville, different markets have different supply and demand, and the markets are doing differently and better for worse because of it. Well, this is a market like anything else, and it has supply and demand. If you're willing to buy it, if you're willing to take the risk, you could be turning, like they said, you bought in 2017, $100 into however many thousands of dollars afterwards. Not too bad. So I just thought this would be kind of a fun topic to bring up real quick about virtual real estate for you all. And who knows, Taylor, I think, we're talking about investing in Puerto Rico. I think I really want to consider investing in some virtual real estate too. Why not?
Yeah, that's really interesting. I mean, I don't get it. But hey, maybe that's just, I mean, clearly it's just me. Maybe it'll take a few years, but
It's because you're a boomer, Tyler.
yeah, basically, yeah. I mean, hell, you start seeing virtual real estate and people are paying 12,000 mana for something. I guess, yeah, maybe I'm missing out. I missed the train on that one. That's awesome, Andy. Though that's a great wild card. I mean, it's there's a lot of crazy things happening in the world of commercial real estate and technology right now, and so it's fun to get to see that kind of stuff. For those of y'all that are joining us on the YouTube channel, thank you again for all those questions. It was awesome. I always love when the audience jumps in and starts, giving their commentary and asking questions. It makes this a lot more fun for us. Don't forget to like and subscribe. If you're listening on the podcast, please leave us a review and a rating. And feel free to join in sometime live. We're always live Mondays at 5:30 p.m. Central Standard Time, going over the Commercial Real Estate Weekly Update. So until next week, guys, we'll see you then.